Jonathan Krinsky is the technician at BTIG. He says the reports of the bear's death have been greatly exaggerated. So you're not willing, Jonathan, welcome back, by the way, to suggest that this new bull market is legit.
Well, yeah, I mean, I think you guys have brought up a lot of good points, but as we hear the choir of new bull markets becoming louder because the S&P is up 20% off the October bottom, what we want to do is look at a few different things. The first is, have we seen 20% rallies within bear markets? And the answer is clearly yes. It may be more the exception, but we saw it in 08, we saw it in 01, we saw it in 1947, 48, we saw it in the Dow in the 60s, and obviously the Nikkei had many 30 to 40% rallies over the course of its secular bear market. So that's the first part. The second part is we want to see, okay, if we are in a new bull market, are we seeing the signs from breadth and credit that we historically see in new strong advances, given that we're 8 months removed from that October low? And the answer on both of those is no. When we talk about percentage of S&P making a 52-week high, given the S&P did make a 52-week high on Friday, we've yet to see more than 6 or 7% of the S&P make a 52-week high. Historically, at the 8-month mark, you've seen at least a handful of days where you have 20% of the S&P making a 52-week high. And then finally, we get to the credit side of things. And if we look at credit spreads like BAA versus BBB versus Treasury spreads, they're actually 20 basis points wider than they were in February. Yes, they've tightened a bit off the October lows, but typically, again, 8 months into a new advance, you're going to see credit spreads tighten significantly. We just haven't seen that. And so, to the points you brought up, we've seen breadth divergences, we've seen credit divergences, and those are two pretty big, important things that we typically don't see at this point in a new bull market.
Okay, but to what degree, if any, does time account for something, and at what point does it trump a lot of the other stuff that you said? If you're 8 months off of the closing low, the further you get away, I presume, the less chance there is of going back.
Well, again, you got to look back a little bit more throughout history. The 2000 and 2008 bear markets, the 20% rallies were very sharp and quick, so we've exceeded that. But if you go back to the 40s, 50s, and the 60s, like I mentioned, for instance, the Dow in 1966 had a 2-year rally that exceeded 20%, did not eclipse the previous high, and then went on to make a new bear market low in 1970. So, we've seen this before. You just have to go back a little bit further. So I do think, an 8-month bear market rally seems a bit unusual for most people because we haven't seen it in the modern era, but history tells us that it can happen. And by the way, the 60s into the 70s was another stagflationary, inflationary environment. So, maybe it is more analogous to what we're seeing right now.